The United States national debt has just crossed $39 trillion. Right now, the U.S. government spends approximately $1.2 trillion per year solely on interest payments. To put that into perspective, that's more than the entire defense budget of $954 billion in 2024. These numbers are incomprehensible, yet they affect you directly. Your savings, your 401k, your job, and the economic future of your children and grandchildren. While many Americans see this as a distant macroeconomic problem, the reality is far more personal. In the next 25 minutes, I will show you exactly how America accumulated $39 trillion in debt, why it matters to you today, and most importantly, what you can do to protect yourself. By the end of this video, you'll understand the mechanics, the history, the projections, and the personal consequences. The story of the U.S. debt crisis begins not yesterday, but decades ago. From 1948 to 1979, the American economy thrived in a system where productivity growth and wage growth moved together. Productivity grew approximately 108%, and worker compensation grew 93%, maintaining a balance between economic output and personal income. During these years, the national debt was rising but manageable. Americans were generally protected because the gains of productivity translated directly into broader wealth distribution. But starting in the early 1980s, something changed. Productivity skyrocketed, growing 253% from 1979 to 2025. Yet median wages for typical workers increased only 116%. This structural decoupling of wages and productivity created a political and economic environment ripe for borrowing. When workers don't see the benefits of economic growth, governments are pressured to fill the gap with debt-funded spending, and that's exactly what happened. By the time 2008 hit, the national debt had already reached concerning levels, but low interest rates masked the underlying risk. From 2008 to 2021, interest rates remained near zero, allowing the U.S. government trillions at minimal cost. Borrowing felt cheap, even almost free. But in 2022, inflation spiked to 8 to 9%, forcing interest rates higher. Suddenly, that seemingly manageable debt became far more expensive. The $9 trillion in debt maturing in 2025 to 2026, often described as a catastrophic maturity wall, is actually mostly a rollover operation. Investors, whether domestic pension funds, money market funds, or foreign governments, must reinvest in safe assets when their treasury bonds mature. The real danger is not the rollover itself, but the $2+ trillion annual deficit on top of the rollover. This is genuinely new debt that must find buyers. One of the most misunderstood aspects of the debt is foreign ownership. Many scripts, including some viral videos, claim that China and Japan could seize control of U.S. fiscal policy by holding the debt. But the facts tell a different story. Foreign holders only account for 24 to 30% of total U.S. debt, while domestic investors hold 55%, and the Federal Reserve along with intragovernmental accounts hold another 20%. Japan, the largest foreign holder, owns approximately $1.06 to $1.18 trillion, which is just 3.1% of total U.S. debt, while China holds only $759 billion, roughly 2.5% of total debt. Moreover, nearly 45% of foreign holdings are governmental and 56% are private investors. When China reduced its holdings in recent years, other buyers immediately absorbed the debt. The foreign creditors will seize control. Narrative is therefore exaggerated. It lacks context. The mathematics behind the United States national debt are far more than just big numbers on a chart. They reveal a structural pressure that drives government finances toward tighter and tighter constraints. The simple fact is that a large portion of the debt, often cited around $9 trillion in recent projections, is maturing and will need to be refinanced at today's interest rates rather than the ultra-low rates of the past decade. This is critically important because when debt was originally issued, interest rates were historically low, often around 2% or even less, thanks to monetary policy after the 2008 financial crisis and through the COVID-19 pandemic. But in the current environment, average interest rates on new Treasury issuances have climbed to 4.5 to 5% or higher in order to attract buyers for government debt that now makes up over 120% of GDP. When you take $9 trillion and apply a 4.5% interest rate, the government is paying roughly $405 billion per year on those obligations. If the same debt had been refinanced at 2%, as it might have been in earlier years, the annual cost would have been about $180 billion, a difference of $225 billion each year simply due to rising rates. That additional $225 billion doesn't go into investment or services. It goes to lenders, and it compounds. Over time, as more debt needs refinancing at higher rates, the amount the government must pay in interest naturally grows. This expanding burden has already helped push net interest payments into the range of $1.10–$1.2 trillion annually, rivaling or exceeding major spending categories like national defense and Medicaid. Because interest rates change with market conditions, these refinancing costs are not static. If expectations for inflation rise, lenders demand higher yields, effectively forcing the government to pay more just to roll over existing obligations. That's why analysts describe the situation as a kind of debt spiral. Past borrowing breeds higher interest obligations, which widen deficits, which in turn drive more borrowing at higher rates. As deficits grow, this snowball effect accelerates unless something changes. Given this backdrop, most mainstream analyses present three broad outcomes for a government facing unpayable debt obligations: default, austerity, or inflation. The first option, default, is politically and economically dangerous. If the U.S. failed to meet its interest payments, even partially, it could disrupt global financial systems, reduce investor confidence, and sharply increase borrowing costs. Historical studies show that even short, technical defaults can severely contract economic output and increase unemployment. Austerity, cutting spending drastically while raising taxes, tends to slow economic growth and can deepen recessions, as seen in European economies that pursued severe fiscal tightening after the 2008 crisis. Politically, such measures are difficult to sustain in a polarized environment without broad consensus. That leaves inflation, a path that some policymakers implicitly accept. Inflation reduces the real value of debt over time, effectively making it easier to service large obligations with cheaper dollars. But inflation isn't just a neutral adjustment. It directly erodes the purchasing power of savings, wages, and fixed-income investments. Every dollar in a bank account loses value when the government expands the monetary base to cover deficits. This is not an abstract theoretical risk. It has played out in histories like Weimar Germany, Zimbabwe, and Venezuela, where governments monetized debt and citizens endured air currency depreciation. In short, the mathematics of debt servicing, rising interest rates, compounding rollover costs, and fiscal constraints limit conventional solutions. Default carries catastrophic financial consequences, austerity risks economic contraction, and inflation erodes individual wealth. Understanding the arithmetic doesn't just clarify the scope of the problem. It shows why the debate over rising debt is not simply political theater, but a reflection of deep structural forces shaping the economy and personal financial security. Let's focus on the reality of interest payments, because they are already consuming resources at a scale most people do not fully grasp. Contrary to the repeated warnings that this crisis would arrive within 5 years, interest payments have already surpassed major national expenditures as of 2024. That year, the United States spent $1,126.5 billion on interest alone, exceeding defense spending, which totaled $954 billion. To put this in perspective, interest payments also exceeded Medicaid expenditures, which were $618 billion, although Medicare, at $1.09 trillion, remains slightly higher. Every dollar funneled into interest payments represents a dollar that cannot be allocated to vital areas such as infrastructure, education, research, or even national defense. Unlike discretionary spending, which can theoretically be adjusted through budgetary processes, interest payments are mandatory. They cannot be reduced without risking default. This is not a distant or abstract threat. It is a present crisis that affects current budgets and the allocation of government resources today. The financial challenge is compounded by political realities. Debt ceiling negotiations in 2011, 2013, 2023, and again in January 2025 repeatedly caused episodic market disruption and heightened uncertainty. Treasury interventions, such as buyback programs restarted at $4 billion per week, attempt to manage the risks associated with rolling over debt. Meanwhile, the bid-to-cover ratios for 10-year Treasury notes, 2.4, and 30-year notes, 2.29, suggest that there is still demand from investors, yet these measures act as temporary stopgaps rather than long-term solutions. The system remains vulnerable to sudden interest rate shocks, legislative gridlock, and persistent structural deficits. A single misstep in policy or an unexpected spike in rates could amplify the interest burden overnight, forcing adjustments in other areas of government spending. The personal consequences of this fiscal reality are unavoidable and will become increasingly visible over the coming decade. If current trajectories persist, by 2030, ordinary citizens will experience tangible effects on their savings accounts, retirement plans, and Social Security benefits. Inflation may erode the real value of cash and investments. Tax policies may be adjusted to cover escalating deficits, and government priorities may increasingly favor debt servicing over programs on which citizens rely daily. Essentially, individuals are paying interest on debt that was accumulated before they were born, a phenomenon economists describe as intergenerational theft. The moral dimension is as significant as the financial one. Your children inherit obligations they did not create, and each year that corrective action is delayed increases the cumulative cost. Every fiscal delay compounds the burden, turning what might have been manageable into a nearly insurmountable problem. Understanding the theoretical framework of modern monetary theory, MMT, provides further nuance to this discussion. MMT proponents, such as Stephanie Kelton, argue that countries that issue their own fiat currency, like the United States, cannot involuntarily default on debt. According to this view, the only constraint on spending is inflation rather than insolvency. MMT theorists posit that a government can always create more currency to cover its obligations, and the real danger arises only if excessive money creation pushes the economy into overheating. However, the broader economic consensus paints a more cautionary picture. In the 2019 University of Chicago IGM survey, not a single top economist endorsed the core tenets of MMT. Similarly, Federal Reserve Chair Jerome Powell has dismissed its premises as just wrong. Historical precedents underscore the risks. Countries such as Weimar Germany, Zimbabwe, and Venezuela experienced hyperinflation when governments expanded the money supply without restraint. These examples demonstrate that while MMT may offer theoretical flexibility, in practice, unconstrained money printing carries profound consequences for currency stability and purchasing power. Even the example of Japan, often cited by MMT advocates as a model of sustainable debt, is unique. Japan's high domestic debt ownership, combined with persistent deflationary trends, has allowed it to maintain extraordinarily high debt levels without triggering runaway inflation. The Japanese model is therefore not directly transferable to the United States, where demographic shifts, a reliance on foreign investors, and inflationary pressures differ markedly. Recognizing this debate is critical for understanding why policy decisions can appear inconsistent or even irrational. Some policymakers genuinely believe that warnings about rising debt and inflation are overstated, while others anticipate that structural constraints will inevitably force difficult choices. The tension between these views contributes to market uncertainty, public confusion, and ongoing fiscal vulnerability. This is a story of math, history, policy, and morality. It is a story of inevitability, but also a story of empowerment. The U.S. debt crisis is happening now, and how you respond will determine not only your financial future, but that of your family and your country. Understanding the numbers, understanding the mechanisms, and understanding the personal stakes is no longer optional. It is essential.